Is the Fed expectation the key thing for markets, and have they altered this morning?
In the short term, yes. We think they're priced in far too much, 100 basis points over the next year. But really the story is about inflation, which is, as today's numbers would tell you, the hourly earnings are not up very much. There's very good news on the participation rate. And that's what the Fed is addressing as we speak, right? What's the story on inflation?
So what is your expectation then for rate cuts in the year ahead?
To get 50 to 75 over the course of the year, yes. I think the central banks across the world are going to be highly supportive, and that's an important part of the story, but not the entire story. The much more important part of the story is where is valuation, which has been the major support for the last several years, especially this year. And in all this news flow, we should not lose sight of that.
I want to go back to the point you just made. What is the story with inflation?
The story with inflation is a difficult one. At such low unemployment rates, you would have expected that wages would be rising faster. And I guess people are coming around to the view that, or economists are, that just looking at the headline unemployment rate is not telling you the complete story, that there is room for the participation rate to improve, that workers are coming out of the, distressed workers or disappointed workers are coming back, joining the workforce. Older workers like me are hanging around and staying longer in the workforce, things like that.
Ian Shepherdson of Pantheon Macroeconomics is also joining us now. Ian, what was your take on the jobs number this morning? Was it strong enough to delay any rate cuts, excuse me?
Yeah, not by itself, but, we've got a whole month of extra data to come out before the meeting on the 31st. So what I think it does is set up a very interesting few weeks, because if we get a run of numbers that move to the upside, then the market's probability of a rate cut is going to drop further. It's taken a real pounding today. The market has taken out completely the idea of getting a 50 basis point easing and is now saying that the chance of even getting a 25 is less than 100%. And just a few days ago, markets were absolutely convinced there'd be action. So let's say we get strong retail sales, strong CPI, strong PCE deflator numbers over the next few weeks. It's not impossible to think that by the time of the meeting, the market's saying, hey, Mr. Powell, it's a 50-50, you choose. That wouldn't surprise me at all, and it's a very big move from where we've been, and I think probably justified, because to my mind, the labour market is strong enough that the economy doesn't really need to be supported by lower rates at this point.
Vinay, you mentioned valuation is a reason to believe that the market can stay supported, but I assume you mean valuation of equities relative to where bond yields are.
Most of all,
yeah.
But globally, maybe even in absolute terms.
Yeah.
So our stance has been to stay invested, to stay diversified, highly diversified, overweight risk assets like equities. And globally, countries like Japan, emerging markets have underperformed severely. That's one side of the long position. We underweight industrials to be a little defensive. We overweight long treasuries also to be defensive. And on the other side in the US, we're overweight communication services. We're overweight consumer discretionary. But staying invested and just keeping sight of the targets.
International.